everyone. Lou Desepoli here, Heritage Financial Advisory Group. Happy New Year to you all. Wanted to spend a few minutes with you and recap what's taken place in the financial markets in 2017 and some things that we think we can expect for 2018. So with that, thanks for tuning in, and let's get right to it. First off, 2017 was a solid year for the financial markets. Equities performed well. The returns are about 19%. And let's review what happened here. Corporate America is making money. And when companies make money, it trickles into the economy, and the economy has done well. Technology was the big winner. The companies that you know, Google and Apple and Amazon and the like, they were the big gainers in the technology sector in 2017. But part of the reasons that the economy was thriving in 17 was the anticipation of the tax cuts long before the tax cut reform was enacted. So with that, the speculation that individuals would do better, companies would do better, and it translated into higher stock prices and the financial markets doing well. Something else that's taken place through the past year is a lot of deregulation, where in the political world, deregulation or the relaxation of business requirements and standards that allows companies now to compete more freely for business without a lot of the red tape. And that's translated into economic recovery and companies doing well and adding corporate profits. And that continues to be the theme for 2018. While we did see interest rates increase a little bit in 2017, I think we had 2 or 3 interest rate increases. We do see that carrying over into 18, but it has not been enough to really hurt the growth of the economy. So, with that, there's a lot of things that have resulted in 2017 being a good year. But consumer sentiment is high, and companies are feeling very good about the prospects of a solid economic expansion going forward. Unemployment has been decreased. The GDP on an annual basis has increased, and the combination of those two together have done very well, and certainly it's shown by the performance in the equity markets and the financial markets overall. For 2018, what do we see? Well, this year, we think that now that the tax reform has been enacted and it'll be actually felt by employees and corporations in February, we think that continues to be a catalyst for the financial markets going forward. As monies are circulated back into the economy through the form of paychecks and tax reduction, a lot of that will just drive economic growth even further. So we see this as potentially being very big for the economy. There'll be a lot of offshore money coming back from corporations, domestic corporations that have earned it overseas and are keeping it overseas. But when that comes back and there's an agreed upon tax rate about 21%, that those companies will pay tax on those monies, that will be back here for expansion of companies, for payment of salaries, bonuses, company buying equipment and things of that nature. So that has a very big impact. We cannot underestimate that for 2018. Also, what we see is that the consumer sentiment continues to be high, and that bodes well for people with their financial planning. They feel more confident in the possibility of the markets doing well, and with that, individuals and companies are willing to take their cash and commit them to financial programs in various ways that they can try to grow their money. So with consumer sentiment on the rise, that translates well for the economy and the investment world. We do see interest rates going up again this year. There may be 2, 3, 4 more increases, but as long as the economy is expanding, that is not necessarily a bad thing. And when we look back as to how interest rates have increased in the past, usually it means the economy is doing well. One thing we do expect this year that a lot of people have lost sight on, and it's easy to do when you don't see it, is market volatility. We've seen a lot of volatility in the past, but it kind of went away in 2017. We do think that the markets in 2018 can do well, but we think if they do well, it will be with volatility. And with volatility, You know how that works. Prices are up and down, but we try to keep our eye on the bigger picture as to what we're doing in our financial planning and what the markets are doing overall. But the volatility has disappeared, and we're looking for that to come back. So we don't want you to be surprised when that happens. It doesn't mean that economic expansion is not underway, but we do expect volatility to come back. We are also focusing on a diversified portfolio approach. We maintain a diversified approach to managing risk. We feel that that is the best way to do it. We don't want to commit all our money into a handful of companies or investments, because then you're really adding risk to the portfolio, and that may not end well. So diversification is key to control the risk and add to the performance. So those are just a couple of the themes that took place in 2017 and what we see in 2018. But as always, if you have any questions, we're here to help you. We'd love to meet with you. It'd be great to get together, review our progress. It's been a great year, and we hope we can continue it. But with that, feel free to check in anytime. We'll stay in touch with you. And as always, if you have any questions, call us. Or if you know someone who is really not getting the service and the advice that they deserve, feel free to give them our number. We'd love to sit down with them and review their plan and see if making changes makes sense. So with that, all the best for a great year, and we'll see you soon.